Today, the calm before the storm. The DFA Daily to the 3rd of June 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. So, we can be pretty sure now that unless the ABS makes a revision to today's GDP outturn for March 2020, our luck has run out and we are in recession. Still, more than 28 years without a drop is pretty amazing, and yet you can thank strong migration for supporting the numbers. Indeed, Josh Frydenberg has declared Australia is indeed in recession.
Is Australia in recession today?
Well, the answer to that is yes, and that is on the basis of the advice that I have from the Treasury Department about where the June quarter is expected to be.
Now remember that GDP is measuring activity in the economy, whatever the source. And as I've argued before, it's a very bad measure of anything important or useful, and yet it has become the touchstone for most economists. Personally, I think there are better measures, but that's a story for another day. The ABS reported that overall activity in the Australian economy shrank by 0.3% in the March quarter of 2020. This was broadly in line with market expectations. It translates to an annual growth of 1.4%, down from 2.2% previously. And we know that the next quarter will be worse. So 2 negative quarters are flagged as a technical recession. And this is the first decline since March 2011 at the top level, although we have had some GDP per capita drops more recently. And I'm expecting a June drop of somewhere between 6 and 7%. So this is the first recession since the first half of 1991. Given that we've been getting information drips for the last few days, the results are in line with the previous indicators. That said, the household consumption data was much weaker than expected. The theory was all those toilet roll purchases and the like would support the result, but it was down 1.1%. In fact, it was spending on some services like hospitality and transport which took the hit, but so did retail, down 0.5%, compared with the plus 0.7% in the quarterly survey. Possibly the loss of international tourism spending is part of the reason for this. And again, the hours worked data caught my attention. It fell by 0.9%, which is a larger drop than you might have expected from the wobbly monthly labour market releases. The measure tells us about working activity, of course, and other measures of activity around investment were also down, with dwelling investments off by 1.7%, and that was actually better than expected, but mainly pre-COVID. So while dwelling approvals have held up better than people thought they might, we've got to expect the rate of contraction for both new dwelling investments and renovations and additions will become more significant ahead. Business investment was down 0.8%, and the deep falls in business confidence in April are signalling sharper contractions in business investments in both the June and probably the September quarters. The governments, both at the federal and state level, have been, of course, spending big, and so the so-called public demand was up 1.5%. Without that, the numbers would have been much, much worse. The trade data was mixed, as you might expect. The fall in the entry of international students, which is perhaps 50% down, and the shutting of the borders in March, which has squeezed out foreign tourism, pulled the numbers down. But net exports added 0.5 percentage points to the growth, partly because Australians generally travel widely to foreign parts, and that was turned off, helping to drop imports by 6.2%. Resource exports were unchanged in the quarter, and total exports contracted by 3.5%. And inventories fell as sold items were not replenished, down 0.2%, and consumer spending also had an impact, buying, for example, office equipment for home use. And more broadly, spending across other main expenditure categories declined, including vehicle purchases, which fell 2.4% over the quarter and down 9% over the year, vehicle operations, which were down sharply at 3.9% over the quarter or 3.5% over the year, and services spending as a whole down 2.2% over the quarter and down 1% over the year. Looking at some of the states, New South Wales was the weakest of the states in the 3 months to March as a result of the severity of the summer's bushfires and subsequently the high case count for COVID-19. State demand fell 1.5% in the first quarter and down 0.7% over the year. Business investment, consumer spending and residential construction were all off. Victorian state demand weathered the initial consequences of COVID-19 much better, only edging 0.1% lower in the first quarter to be up 0.9% over the year. However, dwelling investment was far less negative. A 5.1% gain for renovation work largely offset a 3.8% decline in new construction, keeping the decline in total housing construction to just 1.2% in the first quarter. And Western Australia was the strongest performing state in the first quarter, activity rising 0.9% in the 3 months to March, 3.4% over the year. Household demand contracted as in the east, but non-residential construction surged 15% in the 3 months to March to be 23% higher than a year ago. Resources helped here for sure. Agriculture was particularly soft nationally in the first quarter, down 2.4% over the quarter, and that's a result of reduced livestock and grain crop output, of course partly linked to the drought. Annual output posted a double-digit fall at 10.1%. Ahead, it will get worse, much worse, as household spending collapsed in April, judging by the retail sales reports, and is yet to recover. And the services sector, such as healthcare, education, hospitality, may have picked up a bit in May, but are well below normal levels. Consumer sentiment has recovered, at least a little, but is still well below normal too. And in addition, international travel is still banned, business confidence remains near historical lows, and immigration has stalled. And while JobKeeper payments will help for a time, there is a fuse on this currently, of course, into late September. Whether you look at trade, service exports, residential construction or business investment, things do not look good. And of course, households are under pressure as disposable income is being crushed. So in that context, it's worth reviewing Philip Lowe's statement from yesterday, where the RBA said that the Australian economy is going through a very difficult period and is experiencing the biggest economic contraction since the 1930s. In April, total hours worked declined by an unprecedented 9%, and more than 600,000 people lost their jobs, with many more people working 0 hours. Household spending weakened very considerably, and investment plans are being deferred or cancelled. Notwithstanding these developments, it is possible that the depth of the downturn will be less than expected earlier. The rate of new infections has declined significantly, and some restrictions have been eased earlier than was previously thought, and there are signs that hours worked may have stabilised in early May after the earlier very sharp decline. There has also been a pickup in some forms of consumer spending. However, the outlook, including the nature and speed of the expected recovery, remains highly uncertain, and the pandemic is likely to have long-lasting effects on the economy. In the period immediately ahead, much will depend on the confidence that people and businesses have about the health situation and their own finances. Now, I think that probably sums it up quite well. And then, of course, you have to ask the question, well, so what's happening to the stock market, which, of course, ended at a very significant high compared with recent times. And there is a disconnect, a fundamental disconnect between what the markets are thinking and what we're seeing in the broader economy. We will know ahead, of course, who is more right. But I have to say, I think stock markets here and overseas are definitely over-enthusiastic, and I am expecting some further corrections as the reality of what's going on from an economic perspective comes through, and as we see more contraction across the globe. So I called this episode The Calm Before the Storm because essentially this quarter is relatively benign. But I'm afraid that the June quarter will be when we really get to hear just how bad things are, and from that point we will be more likely to be able to judge the path of recovery. I am still of the view that at the end of next year unemployment will be a lot higher, that more households will be under financial pressure, and that globally there will still be considerable disruption to trade, imports and exports. So we are not out of the woods yet. In fact, this may be the end of the beginning, but it's certainly not the beginning of the end. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.